It is possible to have a high income in retirement and still pay 0% capital gains tax on your investments. With a little bit of planning, you can, one, pay less in tax, which is always good, but also you could possibly pay less in health insurance costs if you're retiring before age 65. Now, the difficulty with taxes sometimes is that a lot of people think, well, everybody's got to pay them, so just pay it and be done with it every year. You know, we're all in the same boat, so we just got to do it. But what many people don't realize is that there's a lot of pages of the tax code that are there specifically to help us pay less tax. So if it's in the tax code, might as well use it for our benefit. And you don't have to be a billionaire to get preferential tax treatment. So in this video, I want to share 3 things with you. I'll bring it up. It's going to be the income sweet spot to know, and then also how to do this. And then third is what to watch out for so that we don't have to pay more tax than we need to. Before we get into it, if I haven't met you yet, I'm Dave Zoller, and my team and I have been helping people retire for 14 years by focusing on 3 key areas in retirement. It's the income planning, the investment planning, and then tax reduction strategies. We help a select number of clients, but we created this channel to share what's working with them for people who are not clients too. So if you're thinking about retirement, subscribe so that you don't miss these weekly videos to make your retirement better. The next video is actually going to be on a few red flags to be aware of this year related to your retirement. So let's get into it. The first thing to cover is what's the income sweet spot where you can get a 0% tax on long-term capital gains on your investments. And just remember, there are people living on 10 to 20K per month or more from their accounts each year in retirement, and they're still able to pay and use a strategy to get 0% tax on long-term capital gains. And I'll show you how to do that and give you some examples. Now, to do that, you need a taxable income. The big keyword is taxable income of $41,675 if you are single. So $41,675 if you're single. And then if you're married, the number is taxable income $83,350. Now these are 2022 numbers. I'll go over an easy to understand example, and then I'll share how some people can still have a high income and still take advantage of this. So let's pretend that there was a couple that was getting an income from 3 sources in retirement. They just retired in their early 60s, or it could be any time before required minimum distributions. So they are getting a income from Social Security. We're just making this up. This is from their savings. So now this is not from IRAs, but from either bank or investments that they have that are non-retirement. And then they get dividend interest of 10K per year that just come naturally from the investment account. So for this example, the only taxable income that they have is going to be Social Security and then dividends. So 40K taxable income. And again, Social Security isn't even taxed 100% depending on different income levels. But for this case, we're just pretending like that's their taxable income. So for this fake example, they might be able to sell investments that have a long-term capital gain of about, what's the difference between these two numbers, of about 40K or so, and still pay a 0% tax rate. Whereas if they had higher income, if they were taken out of IRAs, or if they had higher Social Security and other things like that that add to taxable income, they might be paying 7 to 10K in tax. So just with a little bit of planning ahead of their income plan before they're actually starting to take it, and really no sacrifices in income, they can save possibly 7 to 10K per year. It's not too bad. Next, let's go over when you're most likely to take advantage of this. And then I'll share what people are doing to prepare themselves for this ahead of time if you want to have a high income in retirement. And if you're liking this video so far, please click the like button so that hopefully YouTube suggests it to other people like you. Now, let's get into the sweet spots of when to take advantage of this strategy, this possible strategy. One period of time that people can use this strategy is if they are unemployed for a year or 2 or a few. Sometimes retirees, they plan on doing something in the future, maybe part-time work or some sort of income in retirement, but they might take a few years off, from their regular career, take a break, and then get into something that may be more interesting to them, but just part-time. So that could be a period of time to look at this strategy where income is much lower, taxable income is much lower. Another way that you might be able to take advantage of this is if you're self-employed and you have a little bit more control over your income versus someone who is a W-2 employee and they just get paid whatever they get paid. But the most common time that we see people take advantage of this is for retirees between age 60 and 72. It's after work is done and before they're starting Social Security sometime in this period and before they're starting required minimum distributions. There might be a sweet spot somewhere in this period. At this point, you might be thinking, I don't want to really lower my income just to pay 0% capital gains tax. It doesn't seem worth it. Well, you don't have to do that. Many retirees actually pay 0% capital gains and still get a large income from their savings and investments, but you got to do a little planning ahead of time, really the years before retirement. What they do is they start to build up their non-retirement funds or their non-IRA pre-tax monies or non-Roth monies and build that up in an account before they actually retire. In doing so, they're building up a nest egg of money that doesn't have to get a big tax hit when you withdraw out of it. Whereas if you're using your pre-tax, say it's IRA or 401k monies, every dollar that you take out is counted towards taxable income. So what they did in planning ahead was building this bucket up because that's going to have the least tax impact for withdrawals if they were using this for the first few years of withdrawals. So this upcoming example, it's got some big numbers in it and it's not relatable to everyone, but I want to at least share the example with you and then give you a few warnings if you're thinking about this, or just some things to watch out for if you're seeing if this could be a strategy that maybe you can implement. So this couple, let's pretend they want to live off 10K a month in retirement. So they plan out their retirement plan a few years ahead of time and they see what it looks like and what's possible and sustainable. And then the last few years of working, they continue to build up that non-retirement account and bank account, knowing that this is going to be the source of money for the first 3 years or so. Then they will use those accounts and the investments that don't cause them to recognize increasing their taxable income. This could essentially cause them to have little or no taxable income for those 3 years. Then they can choose the investments that have the highest gains and sell those up to that 83K taxable income number. And one other thing to think about as I'm saying this, with large capital gains, if you have some investments that do have really large capital gains in them, if you're charitable, think about giving a portion or all of those investments that have the biggest gain straight to the charity versus selling it and then giving to charity. You probably already know about that, but that's one other thing that popped up. I'll actually include a different video up here about how to do that with donor advised funds. If you don't want to give everything to the charity that year, if it's a big gain or a big amount, but rather spread it out over a few years, but get the tax benefit this year. So look for that video. Now let's get into some of those traps that some people fall into if they're thinking about this strategy or if they implement it. The first one is implementing the strategy and then getting surprised in December because of tax inefficient funds. Now those tax inefficient funds are the ones that might recognize gains within the funds themselves without you even realizing it or without you having any control over what the funds are doing. And you might have seen that before on your tax return where you're wondering, why are these big gains here? I didn't take anything out. I didn't use it. I didn't sell anything. Why am I recognizing and having to pay tax on these gains? Many funds will do this and you really have no control over it. Really, two of the two things you can control in investing is fees and taxes. So what ends up happening is that the plan is implemented, this 0% capital gains tax plan is implemented, and then they recognize gains and they're doing it all, and they're under the 83K taxable income. And then we see in December, another 30K of cap gains gets recognized. One person I saw at the tax firm actually was very surprised to see $60,000 in additional capital gains, and he didn't sell anything or use any of the income. It was just the tax inefficient funds. Then what would happen is that increases the taxable income, it increases the Social Security, how much is taxable there, and it's just a big surprise. So tax efficient funds are really important in retirement. Those who don't plan this way, it causes them to pay a lot more tax than they should. The other thing to watch out for, if you're thinking about this strategy, is one that I actually already mentioned. And if you're in a period of low income and you're not recognizing these gains on purpose, then your Social Security may not be taxed, or it might be taxed at a lower rate. Some people, they don't realize this and they implement this trying to do the capital gains tax strategy, and then they their Social Security income gets taxed at a higher level and then increases their taxable income. So as you already know, taxes play a big part in retirement planning. When we're evaluating the value we can provide for clients, we look at the investment alpha or return, which is important. And then we also look at the tax alpha, which is really reducing how much tax you pay, which can add to returns. And remember, there's a lot that goes into this. Just make sure that you talk to a financial professional before implementing these strategies, just to make sure you're not making any mistakes and you're thinking through all the steps. I hope that was helpful. If you're subscribed, then be on the lookout next week for a video on some red flags to be aware of related to your retirement this year. Thanks for watching, and then I'll see you in the next video.